Hello, Marcus here. This particular video is meant to be embedded into my new blog post entitled Why You Should Avoid Stocks. I thought I'd add a little bit of multimedia to the post in addition to the numbers that you see in the tables. Go over some graphical representation of the markets over time. Now, if you found your way to this video by means of YouTube or just social media, you can find the blog post at muhs.ca/avoid stocks. So I gave the blog post that title to be a little bit, clickbaity, I'll admit. And the idea, of course, is to not avoid stocks. Here's why. Looking at the blog post itself, you'll see I have listed throughout all of my lifetime, going back to when I was born in 1981, every year, why you should avoid stocks. What reason was given out there in the news why you should avoid stocks, whether it be economic catastrophes, pandemics, war, just general bad economic numbers like high unemployment, inflation, whatnot. For every single year, there was always one or a couple of headlines that scared investors out of stocks, either avoiding stocks or actually going as far as selling all their stocks out of fear. And every single time someone did that historically, they made a massive mistake and they lost money. It does not make any sense to ever try to even time the markets. And I know oftentimes we're not deliberately trying to time the markets. When we make these decisions, it's an emotional decision. It just doesn't feel good to be in stocks when you've got all sorts of reasons screaming at you to get out. Well, look at the tables in my chart, in my blog post again, all the different reasons we had in the past. Now I want to show you one of my favorite graphs. This graph comes by way of, originally it's the Dimensional Funds Matrix book that I think publishes the originating numbers. The Matrix book itself is a great tool for us advisors when we're in front of our clients. We can show what the market return was from year X to year Y, and also really kind of show the negatives in between and sort of what happened. This right here is a graphical version of the Matrix book. And the guys at Interact FA did a wonderful job of making this a really nice tool we can use when we're talking about the markets with our clients. To understand this graph, very, very simple once you understand it. The very, very edge of this graph, the bleeding edge, is 1 year returns. And then, of course, close to the edge, those are 2-3 year returns, compound returns over 2 to 3 years. And as we get deeper into this graph, we are looking longer term. So again, just to sort of help position ourselves, we see at the top left here, top right, we see 2024, the markets had a return. This is the US total market, 25%. And in 2023, 26.6%. 2022, the markets were down 20%. Now if we move up a couple of blocks, this here shows you 3 years compounding, 2022 to 2024, in which the markets returned 8% annually. So you see, even if you invested at the beginning of 2022, if you remember that year, the market high was, I think, January 6th. So you were really feeling bad for that year and a half pretty much. Throughout 2022, all the rate hiking, inflation, war in Ukraine, all that stuff that was going on, all the stuff yelling at you to get out of stocks. You just simply ignored it all, and we're talking super short term here, and you just stayed invested. The nice returns in 23 and 24 brought your annualized return up to 8% now. Now again, this is just US stocks. I can show you all the charts for international and Canada and everything else, but I'll keep this video from going too long. For the US, we have a ton of history. This goes back to 1927. And you see here the Great Depression even. If you had the worst of luck and you invested at the beginning of 1929, your first year was negative 15%, and then negative 29% and negative 44%. Really bad luck. And we had more recent times like 2000, 2001, 2002. If you started investing in the year 2000 at the market high, and I remember if you look at my blog post, I show if you invested at the beginning of 2000 on the S&P 500, your annualized return from that point onward was 7.7%, below the long-term average, but still positive. So even if you just sat through all the noise, over the short term, things look really bad. First 3 years of investing, you were down a total return, negative 38%. You lost more than a third of your portfolio. And it just looked like no end was in sight. But A few years later, you were positive. And then things did get worse again. We had the great financial crisis, so things did look really bad. If you were investing for only 10 years, 2000 to 2009, you had a negative return in U.S. stocks. Now, over that time period, you diversified and had Canadian and international as well. You did okay. But I'm just looking at U.S. here. Just looking at one volatile asset. First of all, how bad was it historically? And what happens if we simply ignore it all and just wait? But anyway, so the main takeaway from looking at this graph is that obviously when you look longer term, so ignore everything in that first 10 years. So along this diagonal, 10 blocks deep is your 10-year returns. Every 10-year cycle, for every 10-year span of years. Over 5 years, whether it's green or red, is completely random. No advisor is going to help you predict, this is the time to be in the markets, this is the time to be out of the markets. If they're trying to help you predict that, they're probably going to fail at that. Now, if we connect your investments with your goals and we determine your goals to be longer than 5 years, first of all, if you have a goal that's less than 5 years, you definitely should not be investing everything in stocks because, again, the outcome is random. You don't know if you started investing here, 5 years later you need your money and you're down. This is not even the worst case scenario. You're down almost 10%. But you don't want to take that chance with your money if your goal is only 5 years away. If your goal is longer term, you can take a bit more risk with your money. I would say even 6 to 10 years, there were 10-year time periods where the markets were negative. So 6 to 10 years is also not a time to gamble with your money being 100% in stocks. You should be looking at something more balanced, certainly diversified regionally, but also diversified into other asset classes. But when we look beyond 10 years, as long as you psychologically can sit through those declines in the market, you'll be okay for the most part. Exception again being those very extraordinary circumstances. This is called tail risk, left tail risk in this case, where you did have time periods in the past where up to 15 years the markets were negative. If you adjust this to inflation, it looks even a little bit uglier. A couple of red spots in the 1960s, 70s, and thereabouts. But yeah, beyond that, it's nothing but green fields. Now, I can't guarantee anything. All I can say is if you can connect your investments to a goal through a financial plan, you're probably going to have a better chance of succeeding. Let's just leave it at that. And if you can think, noise will always happen every single year. If there's noise right now in the news while you're watching this, whether it's tariffs or whatever else comes up, that news will eventually abate, and then there will be other news to be worried about, and then more news after that, and more news after that. But how will that news affect what your portfolio is worth when you retire? Even if retirement's less than 20 years from now, how will exactly what happens today, what happens in the markets today, or what happens in the markets this month or this year, how will that impact your portfolio's value in the year 2040, which is only 15 years away? It won't. It won't have any effect whatsoever on your portfolio's value in 15 years. The things that will affect your portfolio's value in 15 years will be whatever's going on in the news in 15 years. And if you're going to retire in 2040, then you probably should have already scaled back your risk leading up to that. And that's another reason why you want to work with a good financial planner. As you're getting closer to your goal, as you're reviewing your plan regularly, you should make sure that your investments, if they are needed to supply income to support your lifestyle in retirement, they should have already been scaled back. Now, if your retirement's far away, none of this should be anything you need to worry about. So anyways, hopefully you took the time out of reading the blog post to watch this, and I'll leave you to read the rest of the blog post. Take care.